There was a moment when the entire American financial system depended on a single man unlocking a door. It was October 1907. Banks across the United States were collapsing. Investors were lining up in the streets, trying to withdraw their money. The stock market was crashing, and the government had no way to stop it. So one banker gathered the most powerful financiers in New York and brought them into a private library. Then he did something extraordinary. He locked the doors. And according to witnesses, he told them no one was leaving until they agreed to save the American financial system. For hours, the fate of the economy was decided inside that room. The man holding the key was John Pierpont Morgan, and the system he saved would eventually force the United States to create something it had never had before: a central bank. But the real question isn't how Morgan saved the system. The real question is why the system needed him in the first place. Because when financial systems lose trust, someone always ends up holding the key. And this isn't just history, it's a diagnosis. This is the banker who saved the U.S. economy. Picture the world in 1870. The United States had just survived the Civil War. Railroads were exploding across the continent. Factories were rising. Cities were growing. But beneath that explosive growth, something fragile was forming. Because while America was becoming the world's fastest-growing economy, its financial system was chaotic. Banks failed regularly. Speculation was rampant. Railroads collapsed under mountains of debt. And the institutions meant to stabilize markets barely existed. Trade routes pulsed with steel, grain, coal, and capital. But the system moving that wealth was fragile. Money moved through a tangled web of private banks, investors, and industrialists. And when panic struck, there was no central authority to stop it. Wealth was transforming society faster than wisdom could keep up. Markets were becoming larger, faster, and more interconnected, but trust was thin. And in a system built on credit, thin trust is dangerous, because credit is not just money, it's a belief. So what happens when a civilization becomes financially powerful faster than it becomes financially stable? History's answer was a single man. In that world, John Pierpont Morgan emerges, part banker, part strategist, part financial general. Think of him as something like a modern hybrid of a central banker, investment titan, and corporate restructuring specialist. But what made Morgan different wasn't just his wealth. It was how he understood power. Most investors chase profits. Morgan chased control. On the surface, he looked like another wealthy banker operating from New York. Underneath, he was building something else entirely. A system of influence that stretched across railroads, banks, steel companies, shipping lines, and government finance. And to understand why, you have to understand how Morgan saw markets. To him, finance was not about buying assets. It was about organizing chaos. Because Morgan believed that markets don't fail when money disappears. They fail when trust disappears. And when trust disappears, someone must restore it. Morgan's philosophy started with a simple idea. Finance isn't really about money. It's about structure. Most investors chase profit. Morgan chased control. Ownership, he believed, was temporary. Control was permanent. And this is where Morgan saw something most financiers missed. On the surface, markets looked like chaotic competitions between companies. Underneath, they were fragile systems of incentives. If those incentives became unstable, the entire system eventually collapsed. Morgan treated finance like a circulatory system. Blood moves nutrients through the body. Money moves trust through an economy. When circulation is healthy, the system grows. When circulation fails, the system weakens. But Morgan discovered something dangerous. A financial system can grow faster than it stabilizes. And when that happens, chaos spreads. That realization became the foundation of what historians later called Morganization. The process was simple. Find industries collapsing under chaotic competition, inject capital, take control of management, merge competitors, eliminate destructive price wars, restore stability, then repeat. The railroad industry became Morgan's proving ground. By the late 1800s, railroads powered the American economy, but the industry was collapsing under its own success. Hundreds of competing companies built overlapping tracks. Executives borrowed aggressively. Investors flooded the industry with capital. At first, growth looked unstoppable. Then, the system began to break. Too many railroads, too much debt, too little coordination. Companies slashed prices to survive. Profits disappeared. Bankruptcies spread. And this is where Morgan stepped in. One famous example was the Erie Railroad crisis. The company had collapsed under the weight of debt and mismanagement. Morgan reorganized its finances, replaced leadership, and stabilized operations. But the real change wasn't financial, it was structural. Morgan began coordinating multiple railroads to prevent destructive competition. Prices stabilized, routes were standardized, confidence returned. And this revealed the deeper mechanism Morgan had discovered. When competition becomes chaotic, markets don't stabilize themselves. They reorganize around powerful coordinators. Morgan didn't just invest in railroads. He reorganized the system. Within decades, his influence stretched across thousands of miles of American infrastructure. Not because he owned everything, but because he controlled the decisions that kept the system functioning. And once again, the same rule appeared. When trust erodes, the math stops mattering. Morgan didn't stop at companies. He understood something even more dangerous. Financial systems eventually test governments themselves. In 1895, the United States faced a crisis. Gold reserves inside the Treasury were collapsing. Investors feared the U.S. might abandon the gold standard. Confidence in the dollar began to crack. Without gold backing, the currency itself could collapse. At the time, the U.S. government lacked the financial infrastructure to stabilize markets. So Morgan stepped in. He organized a private banking consortium, and together they purchased treasury bonds using gold. This injection restored government reserves and stabilized the dollar. A private banker had just restored the United States' financial credibility, and he would do it again. In 1907, panic swept through American markets. Banks began failing. Investors rushed to withdraw deposits. The financial system was on the edge of collapse. Again, the government lacked a central mechanism to coordinate a rescue. So, Morgan gathered the most powerful bankers in New York. Legend has it that he locked them inside a library until they agreed to provide liquidity to failing institutions. Banks injected emergency capital. Confidence stabilized. The panic ended. Once again, a private man had stabilized the financial system of an entire nation. But moments like this raised uncomfortable questions. Because a society can survive financial panic, but it cannot survive permanent dependence on private rescue. And if one man could save the system, he could also control it. If this pattern sounds familiar, it should. Financial history repeats this mechanism constantly. When trust collapses, systems search for stabilizers. In the 1600s, Amsterdam merchants created early central banks to stabilize trade finance. In the 1700s, the Bank of England emerged to stabilize government borrowing. In the 1800s, private banking dynasties filled financial power vacuums across Europe. And in the early 1900s, America had Morgan. Different technology, different institutions, same incentives. When markets lose trust, power consolidates. And when power consolidates, systems stabilize. But stability always carries a cost. Because concentration of financial power eventually creates political backlash. Morgan became the symbol of that concentration. By the early 1900s, his network of banks and corporations influenced vast sections of American industry: railroads, steel, shipping, finance. Critics called it the money trust. Investigations followed. In 1912, the Pujo Committee examined how interconnected financial institutions controlled enormous sections of the American economy. The conclusion was alarming. A handful of financiers held extraordinary influence over capital allocation. The response was inevitable. In 1913, the United States created the Federal Reserve System, a public institution designed to provide liquidity during financial crises, so that no private individual would ever again have to play the role Morgan once did. But history rarely removes power. It usually redistributes it. Now look at our world. Global debt exceeds $300 trillion. Financial institutions are so large that they are considered systemically important. Central banks are injecting liquidity during crises, and markets are increasingly dependent on coordinated rescue. Money moves faster than institutions can regulate it. Markets reward leverage over stability, and trust declines because the system appears increasingly fragile. The pattern Morgan revealed still exists. Economic collapse is rarely about money. It's about confidence. Banks fail when people stop believing deposits are safe. Currencies fail when people stop believing governments can support them. Markets fail when people stop believing prices are real. Confidence is the invisible infrastructure holding financial systems together. Morgan understood this instinctively. His greatest power wasn't wealth, it was credibility. Investors believed that if Morgan supported a deal, the system would hold. Confidence followed him. And confidence stabilized markets. Today, that role belongs to institutions: central banks, large financial institutions, global liquidity networks. But the underlying mechanism hasn't changed. When trust erodes, the system searches for stabilizers. Because without trust, finance doesn't function. It collapses. And this is the part of the story most people miss. John Pierpont Morgan didn't just save the American financial system. He revealed something about it: that financial systems don't run on money. They run on trust. Money is just the language. Trust is the infrastructure. And when that infrastructure cracks, power begins to concentrate. Sometimes in governments, sometimes in institutions, and sometimes in individuals, powerful enough to restore confidence when no one else can. Morgan was one of those individuals. But his story forced the United States to confront a dangerous question. What happens when the stability of an entire economy depends on one private man? The answer was the Federal Reserve, a system designed so that no individual would ever again hold that kind of power. But history has a strange way of evolving, because today, financial stability still depends on institutions considered too important to fail. Banks large enough to stabilize markets. Central banks capable of injecting trillions into the system. And investors whose decisions can move entire economies. Which raises a quiet question Morgan's story never really answered. When the next financial panic arrives, who will be holding the key? If this gave you a new lens on money, power, and belief system, subscribe, because the forces that shaped Morgan's world are still shaping ours.